Hello and welcome to the Northeast Spring Market Update. I'm Northeast's newest advisor, Andrew Morgan. Before we get started, I just need to remind you of the general advice disclaimer. Everything that I'm about to go through today is just of a general nature and shouldn't be considered as personal advice. If you're concerned about how any of this impacts you individually, then please contact your advisor directly. Let's get into it. First and foremost, there's been a lot of talk recently about inflation. So as a refresher, inflation refers to the process of goods and services becoming more expensive over time. And in Australia, it's measured by the Consumer Price Index or CPI. The RBA aims to keep CPI between about 2 and 3%, but a range of factors can increase demand on certain goods and services from time to time, pushing up their prices. And this is a problem that we're facing in 2022. CPI has well and truly exceeded the target range due to a number of global and local causes. These include the invasion of Ukraine, which has disrupted supply chains and pushed up petrol prices, as well as local droughts and the rising cost of raw materials being passed on to consumers. And this has prompted the RBA to embark on a series of aggressive rate hikes to soften demand. In August, the Australian Bureau of Statistics reported that the annual Australian inflation rate had reached 6.1% in the June quarter, which was the highest recorded since 1990. And things are worse in the US and UK, with annual inflation rates above 9%. The Reserve Bank has forecast for inflation to peak at 7.75% in the December quarter of 2022, before it's expected to start falling from next year, being 2023, and continue falling throughout 2024. The RBA's push to curb inflation resulted in a sixth straight interest rate rise in October, which drove consumer confidence levels to near historic lows. And the concern here is that low consumer confidence can lead to consumers spending less, and if consumers continue to spend less and businesses begin to cut back on production, the economy can experience a slowdown, which may eventually lead to a recession. And cash rates have risen extremely quickly, from a low of 0.1% at the start of the year to 2.6% earlier this month. And according to most predictions, will likely rise further. The Governor of the RBA said in a statement recently that the increase in interest rates over recent months had been required to bring inflation back to target levels and to create more sustainable balance of supply and demand in the Australian economy. Interest rate futures markets are actually suggesting that rates will rise until a peak in March 23 of just over 3%. But recently, expectations have hinted at rates falling again in the second half of 2023. Indications suggest that Australian property markets fell 1.4% throughout September as the market continued to cool in response to rising interest rates and higher living costs. The RBA's aggressive interest rate rises have made variable rate mortgages much more expensive, and people are reacting by retreating from the housing market. In addition, mortgage customers are actually facing what's called the fixed rate cliff as they roll off ultra low interest rates onto sharply higher standard variable rates. It's possible that recent home buyers are going to be faced with as much as a 50% hike in their monthly mortgage repayments. As shown on the left, traditionally most home loans have been written under a variable home loan agreement, but ultra-low interest rates have produced a massive rise in the number of shorter-term fixed-rate mortgages, some of which were written below 2% per annum. In fact, research by finder.com.au showed that an amazing 46% of home loans written in July and August of 2021 were fixed rate, and indicate that an incredible $158 billion of fixed rate mortgages will mature before the end of 2023. So it'll be interesting to see what impact this has on consumer spending as mortgage holders are forced onto or into borrowing at higher rates. We're always continuing to refine our budget planner, so if you have any concerns about how interest rate rises are going to impact on your personal budget, please reach out and we'll send you through an updated copy of the budget planner. Taking a look at equity markets, and compared to other global markets, the profitability of Australian firms has actually been holding up reasonably well. This chart shows some of the major indexes around the world, including the Australian All Ordinaries in green and the MSCI World Index in light blue. While still returning a negative result, the Australian market held up reasonably well compared to its peers, in part due to the resource sector, stable commodity prices, as well as a low exposure to tech, which is being crunched globally. While the Australian market only makes up around 2% of the global economies, our portfolios are actually overweight to Australian equities, which has helped shelter against some of the global losses. And we also predicted some of these downward movements earlier in the year and moved some money to cash, which is a position that we still hold. Traditional diversification strategies have also been tested as inflation became a serious problem. Traditionally, fixed interest, gold, and even cryptocurrencies are said to be negatively correlated investments, meaning that they typically rise when equity markets fall and vice versa. However, the combination of rising inflation and central banks tightening interest rates have increased bond yields, pushing prices down, resulting in negative returns from both fixed interest and shares at the same time. Therefore, there really has been nowhere to hide, and there seems to be nowhere to turn for downside protection as the normal safe havens aren't working. Looking ahead to the Stage 3 tax cuts from July 1, 2024, the 32.5% and the 37% tax brackets are due to be rolled into a single 30% tax bracket, while the threshold for the top 45% bracket will also increase. Once the changes have come into effect, 95% of taxpayers will pay a marginal rate of 30 cents or less. However, this has been a contentious policy, and Greens leader Adam Bandt, among others, has been pushing for a scrapping of the Stage 3 tax cuts, pointing to the fact that the majority of benefits go to high-income earners. Over the period of 2024 to 2033, the cuts are forecast to cost the federal budget more than $243 billion in foregone revenue. Despite Labor going to the 2022 polls promising not to reverse the policy, Treasurer Jim Chalmers is actually flagging a possible change as soon as next week's federal budget. So we'll have an update for you in our budget review. To wrap up, I'll reference a song from 1972, and that's The Eagles' Take It Easy. Whilst there are certainly fears of a global recession, we simply believe that it's unwise to panic sell now, as it's very common for investors to sell out at or around near the bottom, rather than preparing for market opportunities or buying opportunities when markets start to settle. So indeed, we do exercise patience and caution, and we will still continue to dollar cost average into markets. Of course, if you want to understand how any of this affects your personal circumstances, please do reach out to your advisor directly. Thanks for watching, and take it easy.